Hello and welcome back to the QuantScore Financial Show. Brought to you by Math and Maticians. Today, we bring you the top undervalued and top overvalued stocks for the trading week of January 20th, 2025. Please remember, this video is strictly for educational and entertainment purposes only and should not be construed as financial advice. We're just here to arm you with the numerical knowledge you need to make your own informed decisions. Today, we're strapping on our data crunching helmets to first analyze our undervalued stocks, then following it up with our overvalued stocks for the market week starting Monday, January 20th, 2025. First up, making another return to our undervalued stocks list, let's talk AMD, or Advanced Micro Devices, the chip-making maverick that's been giving Intel and Nvidia a run for its money. At $121.46 a share, this stock is screaming with potential. Now I know what you're thinking, a PE ratio of 106.7? That's higher than a kite in a hurricane. But hold your horses because their PEG ratio is a lean, mean 0.31, suggesting that AMD's earnings growth is outpacing its stock price. And speaking of profits, their forward PE ratio is a respectable 24.1, indicating that analysts are expecting big things from AMD in the coming year. But here's the kicker. Our quant score for AMD is at a rock-solid 2. That's right, our proprietary algorithm has identified AMD as an undervalued stock with potential for massive upside potential. And although a quant score of 2 seems underwhelming, in a market where even decent opportunities currently cost a premium, an undervalued quant score of 2 indicates strong growth opportunities ahead for AMD. This is a stock that deserves a prime spot on your watch list. Next up, we're diving into the world of finance with Charles Schwab Corp., ticker symbol SCHW. This brokerage giant has been a Wall Street mainstay for decades, and at $76.41 a share, it's a bargain you can't afford to miss. Now, I know what you're thinking. A PE ratio of 29.5, that's not exactly cheap. But hold your horses because their PEG ratio of 0.915 tells a different story. It suggests that SCHW's earnings growth is in line with its stock price, making it a solid value play. And speaking of value, their forward PE ratio is a mouth-watering 19.12, indicating that analysts are expecting steady earnings growth in the coming year. But here's the clincher. Our quant score for Charles Schwab is an impressive 3. That's right, our algorithm has identified SCHW as an undervalued stock with significant upside potential in its future. Now let's turn our attention to the ever-evolving world of healthcare with Abbott Laboratories, or ABT, a company that's been innovating and delivering life-changing products for over a century. At $113.45 a share, this stock is healthier than a long-distance runner. Now some of you might be looking at that PE ratio of 33.8 and thinking it's a bit rich for your blood. But hold on a second. That PEG ratio of 2.153 tells a different story. It suggests that ABT's earnings growth is a bit sluggish compared to its stock price, but don't write them off just yet. Their forward PE ratio of 21.55 is like a shot of adrenaline, indicating that analysts are expecting a resurgence in earnings growth in the coming year. But here's the kicker. Our quant score for ABT is a respectable one. That's right, our algorithm has identified ABT as an undervalued stock with the potential to deliver healthy returns. Although extremely low compared to the quant scores of our overvalued stocks of the week, please do not let the low quant score fool you into thinking this stock does not still have room to go higher. Next up, let's journey to the vibrant and rapidly growing economy of India, where HDFC Bank Limited, or HDB, is a dominant force in the banking sector. At $58.39 a share, this stock is hotter than a Vindaloo curry. Now I know what you're thinking. A PE ratio of 19.1? That's not exactly dirt cheap. But hold your horses, because their PEG ratio of 0.97 suggests that HDB's earnings growth is right in line with its stock price, making it a compelling value proposition. And speaking of value, their forward PE ratio is a tantalizing 16.98, indicating that analysts are expecting robust earnings growth in the coming year. But here's the clincher, our quant score for HDB is an outstanding 4, making it the highest quant score for our undervalued stocks of the week. That's right, our algorithm has identified HDB as an undervalued stock with the potential to deliver explosive returns. Last up for our undervalued stocks of the week, let's talk about Qualcomm Incorporated, or QCOM, the wireless technology giant that's been connecting the world for decades. At $161.43 a share, this stock is a technological tour de force. Qualcomm currently boasts a solid PE ratio of 18.39, currently making it the cheapest on our list of undervalued stocks for the week. That's quite a steal if we say so ourselves. Not only does Qualcomm currently have the best PE ratio for our undervalued stocks, they also possess the best return on assets and return on equity on our undervalued list at 12% and 42% respectively. But here's the kicker. Our QuantScore for QCOM is a stellar 3. Our algorithm has identified QCOM as an undervalued stock with the potential to deliver market-beating returns, definitely making it a stock to keep on your watch list for the coming future. Alright folks, it's time to move on to our overvalued stocks of the week. First up, let's talk about a company that's been around since the dawn of the computer age. International Business Machines, known predominantly by its ticker symbol IBM. This tech titan has seen it all, from punch cards to cloud computing. But at $224.74 a share, IBM seems far off a price that would make it a buy. IBM currently has a PE ratio of 32.04, which may be slightly high for the overall market, but actually seems completely reasonable compared to the rest of the tech industry. And with a PEG ratio of 7.29, that's about as appealing as a cold bowl of oatmeal. This suggests that IBM's earnings growth is lagging behind its stock price like a dial-up modem in a 5G world. Our QuantScore for IBM is currently the highest for the week at a sky-high 23. That's right, our algorithm has identified IBM as our top overvalued stock, as well as what we believe to be the best opportunity for the week. Let's move on to our second overvalued stock of the week and talk about Shopify Inc., ticker symbol SHOP, the e-commerce darling that's been helping businesses of all sizes sell their wares online. Currently trading at $103.34 a share, Shopify has been a Wall Street darling providing substantial returns. So, are we suggesting the party is over? We are indeed. At least while the stock is trading at this current valuation. For example, IBM currently boasts a PE ratio of 110.02. Absolutely insane. But that is only a single variable in our problem. To add insult to injury, Shopify also has the highest forward PE ratio on our overvalued stocks list at a mind-blowing 70.92. Sure, their quarterly earnings growth is an astronomical 485%, but we do not feel that currently justifies their high valuation. As for our QuantScore for Shopify, it registered this week at a respectable 12. That's right, our algorithm has identified Shop as an overvalued stock with limited upside potential at this current valuation. Up next, let's talk about the cloud computing behemoth. Salesforce.com Inc.'s ticker symbol CRM. Salesforce been helping businesses manage their customer relationships for over 2 decades, potentially explaining their ticker symbol with customer relationship management. At $324.22 a share, this company has been a Wall Street sweet thing for quite some time. But is the honeymoon phase over? Our charts and data are strongly suggesting so. Although the returns are still positive, Shopify currently flaunts a return on assets of 4.7%, while their return on equity is a meager 9.7%, both representing the worst returns amongst our overvalued stocks this week. As for our QuantScore, CRM comes in with a solid 11. That's right, our algorithm has identified CRM as another overvalued stock with limited to zero upside potential. Alright folks, let's talk about Cisco Systems Inc., ticker symbol CSCO, the networking giant that's been connecting businesses and individuals for decades. At $60.23 a share, Cisco has been a Wall Street stalwart for a long time, but it seems their signal may be fading. Now I know what you're thinking. A PE ratio of 25.78 does not seem bad enough to be on the overvalued list. We typically would agree, and for the most part, Cisco has some strong financials, but where they fall short is in their quarterly growth. Cisco posted a quarterly earnings decline of nearly 24%. As for their revenue, Cisco saw a drop of almost 6% in their quarterly revenue, making it the only stock on our list this week to post a decline in both quarterly earnings and quarterly revenue. That's about as appealing as a dropped Wi-Fi connection. Our QuantScore for Cisco is on the lower side for our overvalued stocks at 7, but that is not to suggest the stock does not represent opportunity. Last but not least, let's talk about Unilever PLC, ticker symbol UL, the consumer goods giant that's been a household name for over a century. From soap to ice cream, UL's products are ubiquitous, but at $55.66 a share, is UL still a buy? It is difficult to say. But we believe Unilever is due for a decline regardless of the best PE ratio for our overvalued stocks at a rather comfortable 20.46. But what ruins their amazing PE ratio in the blink of an eye is their absolutely terrible PEG ratio of 15.08. That's about as appealing as a melted ice cream cone. It suggests that UL's earnings growth is lagging behind its stock price. Our QuantScore for UL comes in to finish off our overvalued list for the week at another reasonable 7. That's all for this week's edition of the QuantScore Financial Show. We've covered a lot of ground today, from undervalued gems to overvalued duds. Please remember, the QuantScore Financial Show is created for entertainment and educational purposes only. The information in this video should not be mistaken as financial advice, so please do your own research and due diligence when your own money is on the line. Thank you so much for watching the QuantScore Financial Show. Don't forget to like, subscribe, and hit the bell icon for more weekly stock analysis. We'll be back next week with more market-moving insights and data-driven predictions. Until next time, stay informed, stay invested, and may your portfolios be ever in your favor.